Most traders, even if they're right on the market, don't have a refined entry strategy. What that basically leads to is entering trades randomly at potentially the wrong time, and it basically leads to poor trading execution. So I want to show you how I mapped and executed this 2R plus trade on EuroCAD in the last couple of weeks, and then run through my top 3 favorite entry strategies. We'll then check them out across EuroCAD and EURNZD to actually get a read on how to execute these entries. So if we start here on EuroCAD, I'm just going to take this away, and I'm going to show you exactly what's going on with price. So I'm looking at the 12-hour time frame, and I'm looking to enter a swing position. So I want to overlay some higher time frame context to understand exactly what's going on. So I'm just going to add here the 2-week time frame. It's my 2-week candle ranges that I'm seeing behind the 12-hour price action on my chart. And what we start to see right here is the emergence of a sell-off until we raid the external range liquidity below this candle range. What we then see is price trades into the internal range liquidity in this leg, tries to go lower in the opening of this new 2-week candle, and trades through. So we have a true market structure shift. So what I wanted to do is look for internal range liquidity in this price leg to get involved in longs. So I simply take a long order and I enter at this point from the fair value gap within this price leg. And then I cover the liquidation of the most recent low. My target is the drawn liquidity, the external range liquidity that sits at the high of this 2-week candle. And that plays out for a really nice 2.41 R. And that's exactly how to get involved using the correct entry strategy in combination with higher time frame context. Let's get into some theory and then look at a couple of different examples. So, what are entry strategies? Entry strategies are systematic methods for timing when to execute a trade after identifying a setup, combining price action with risk management, market structure, but importantly, higher time frame context to ensure we have the highest probability of success. So in this example, we get a sell-off, price retraces into the internal range liquidity, pushes lower, and then we get a shift in structure. We want to enter in this period or point of internal range liquidity. In this example, it's an order block, and we want to target the continuation of the trend. Most traders identify the right setup. Maybe it's a premium zone or bearish structure or clear directional bias, but they're entering randomly without a defined entry strategy, and this leads to entering on hope and getting stopped out and ultimately chasing price. And it matters because you don't want to get stopped out of trades and you don't want to enter at the wrong point or enter too early. So now let's take a look at 3 of the best entry models that I've come across for entering high probability trades. And they're straightforward. So first and foremost, we have an order block entry. We have to combine all of these entries with higher time frame context. But essentially all that's happening here is you get the last sell candle before buy pressure comes into the market, so demand overtaking supply. We get a mitigation of the order block where orders have been accumulated, and then we're looking for continuations. So that's entry 1. Entry 2. Here we see aggressive price action. So this candle in the middle creates volume or signifies volume in the market because we have sell candle, then we have aggressive buy pressure, and what we get is an imbalance between candle 1 and candle 3 where there's no overlap between the wicks, and this creates a fair value gap or FVG. So when price retraces then in the next candle into this imbalance, we can look to take longs. We can get involved at the creation of this fair value gap for continuations. That is option 2. And then we have breaker blocks. So essentially what's happening here is we have sell pressure in the market, and we're anticipating this demand, this supply, this order block, the last buy before the sell, to then hold to go lower. But what ends up happening is it just gets traded through, showing disrespect of this area. So once we get price coming back in to this area here, we can take longs to continue in the same direction. So that's what we're looking for in the charts. And when we combine this with higher time frame execution and proper targets, we can see our trades play out. So we already looked at the fair value gap entry covering the liquidation. So we have order block, buy pressure, and then essentially we get a gap in price between candle 1 and candle 3. So that's exactly where we're entering. And then we're holding to the next range of external range liquidity. Sorry, the next pool of external range liquidity. What could we also have done is, as soon as we then get this next move higher, the creation of this price leg, we also have context to still take out this target. So we can mark that we have an order block right here. So you have order block, and we do also have a fair value gap. So you could again place a trade either from the order block or from the fair value gap. We take the order block, we cover the liquidation, and then we target the high. There is an additional 1.3 trade to the highs. So this is how you can use order blocks, the last sell to buy, fair value gaps, in conjunction with higher time frame context to take strong entries in the market. Now let's look at another example on EURNZD. And what we see is that we get a liquidation of the 2-week high right here. So price liquidates the high, we get a sell-off, and eventually price targets the lows at the next range of external range liquidity at the low of this candle range. So this is our higher time frame target. What we see is that price trades up, trades down, tries to go higher, and then we get the creation of a fair value gap and an order block, the last buy before the sell. Price comes into the order block and then sells off. In doing so, we also get the creation of a breaker block. And I'm going to show you this right here. So this was the demand that was previously holding price, and it just gets traded straight through. This candle here, we get a close, a confirmation below the low. So this then flips, it's a flip zone. It turns into supply in the market that we can use to take entries. So we set our entry at the entry of the breaker block. And in this case, if we just covered the high of the breaker block and targeted the low, we get a 1.46 trade. You can get much bigger multiples than this, but at the moment, it's just about understanding where it makes sense to enter trades, where it makes sense to put your stop loss. And I'm going to add an additional video on stop loss placement in order to get involved in high probability trades. And this actually plays out for a much bigger trade. We're at like 2.5R right now. So how to apply this? Define your criteria for trade entries. For me, I like to take order blocks, fair value gaps, breaker blocks. Wait for price action to create these setups. Enter with your stop loss at safe levels. So I like to cover either the swing points or liquidations of previous swing points, and have clear, defined higher time frame targets. Do not force trades. This is a very abundant area of trading Forex. Trades come up every single day. It's just about being patient and waiting to execute at the right time. I track and analyze 32 Forex pairs. I track 12-hour price action, and I swing trade monthly, 2 weekly, and weekly candles. Once you get good at this, you can do it in 10 to 15 minutes a day. So if you like this content, hit subscribe, and then I'll see you on the next video where we start to look at things like stop loss placements.